Good morning, everyone. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion. I'm here with Guy Berger, Director of Economic Research at Burning Glass Institute, formerly of LinkedIn, of course, and a great analyzer of labor market data. Also here today, Allison Schrager, Senior Fellow at the Manhattan Institute, Bloomberg Opinion columnist, and of course, author of An Economist Walks into a Brothel and Other Unexpected Places to Understand Risk. Folks, it's Jobs Day, and it's happening amid an absolutely vicious tariff-induced market sell-off. The Bloomberg consensus, I'll take you over here now. Bloomberg consensus is that the change in non-farm payrolls will be a plus 140K for the month of March. The consensus also expects that the unemployment rate will stay steady at 4.1%. Guy, it's a tariff world and I'm just living in it. How am I supposed to think about this March data point as we process what's happening with this really shocking tariff policy that President Trump rolled out on Wednesday?
I mean, this is all well before that announcement. So, in some sense, I'm going to look at this data, and the data might not be great because there's other stuff happening already, including, uncertainty and layoffs by Doge that I think would already possibly be making these numbers a little softer. But they're all reflecting a world that's much happier than the world they're going to be staring at with these numbers in a few months. And so I just look at it and I'm like, okay, this is interesting, but I wish we were looking at the June payrolls instead. I
Yeah,
mean,
for sure.
I wouldn't. I don't think we'd like what we'd see, but I think that would be more useful to see.
I mean, is there a scenario in which you say, oh, great, these numbers are good, so we're carrying a relatively strong labor market into this great challenge? Could there be a silver lining kind of story in these numbers like that?
I mean, that'd be. I mean, I guess that'd be a stretch. I mean, let me say it this way: yes, on the margin, but like the numbers are going to be if all the estimates on GDP hits are accurate, and I don't see a reason why not, and we know how the market's reacting, I don't see any reason to like. There's not going to be the numbers would have to be like outlandishly strong for us to think, oh yeah, we're gonna survive this. I mean, we will survive it. It would be very it's going to be very unpleasant, and I don't think there's going to be any strength today that would change my mind on that.
Sure. Allison, sort of same question to you. Like, as you've been watching the economy over the past couple of quarters, any sense that, this economy is sort of strong enough to, withstand or like deliver a least bad outcome from this brutal policy body blow?
Yeah, I mean, household balance sheets are actually in pretty good shape. So, I mean, there's some credit card debt. So,
Yep.
I mean, and also we don't know. I mean, there's more stuff coming in the pipes. Tariffs are bad. They cause all sorts of distortions. They're a tax on consumers, but you know what? Like, so are corporate income taxes. So maybe there'll be a cut there. Maybe that will offset some things. I don't know if they're going to have the political capital to do that now, but if they do, and we have a pretty resilient consumer, the impact on American households it's not going to be good, for sure, but it might not be a complete disaster, depending on what else is coming with deregulation and corporate tax cuts. I mean, I'm not trying to endorse anything. I mean, it would be better if we didn't do tariffs and then we did that, because then we could just have more growth. And I'm just feeling very sad about that missed opportunity. But the good thing is really bad recessions tend to come from household balance sheets that are in terrible, terrible shape. Like, that's why the financial crisis recession was so bad, is it just destroyed household wealth. So, assuming the stock market doesn't fall like another 30%, the economy is actually fairly resilient.
Right, right. And to your point, corporate balance sheets also look, pretty decent. I think you would say, not as sterling as they were in like 2022 and 2023 when everybody got to refi at like amazing rates, and we were all surprised by how resilient the economy was in the face of rate hikes. But like, they're not worse than average. And I think you would, at a minimum, say sort of the same thing about household balance sheets.
Yeah.
Anyway, we're about 5 seconds out from this number. We'll bring the numbers to you. We'll also bring you some market reaction. Okay, so here you go. Your change in non-farm payrolls is a plus 228K, so actually quite a bit stronger than the street had been expecting. A lot of that coming from private payrolls, which are a plus 209K. You do get a negative 2-month payroll net revision, so that's a negative 48K. And this is interesting. Your unemployment rate actually does tick up, even with that strength in non-farm payroll. So we're looking at a 4.2%. That's up from 4.1% and higher than consensus had been expecting. We'll go through the other details in a jiffy here. Labor force participation rate ticking up a little bit, 62.5%. Underemployment rate ticking down a tad bit, 7.9%. Nothing shocking in the average hourly earnings month on month. You end up getting a 0.3%, but I guess there's something in the base effects here because your average hourly earnings year on year actually ticking down 3.8%. And no move, actually a slight tick up in your average weekly hours, all employees, but that is consistent with what the street was expecting. So Guy Berger, how do we deal with this cognitive dissonance? A little stronger than expected on the non-farm payrolls, a little weaker than expected in the unemployment rate.
I mean, this happens from month to month. So, I think if it wasn't for everything else that was going on, I would probably spend a lot of time thinking about what is happening here. With a weak, a weakish household survey and a strong establishment survey. But I mean, I guess it sort of suggests the economy is not doing. I mean, the labor market's doing okay, fine, good, even coming into to these huge new tariffs. And we will see how much of a dent those tariffs take into it. I think that's really it. That's my commentary on it.
Yeah, and to your point, we do see S&P 500 futures up a little bit here off of not on the day, but off of their lows earlier. We are seeing a slight tick up from the lows in the 10-year treasury note, but this is a bloodbath as markets go. So I am really grasping at straws for some positive interpretation of any of this. Allison, let me go over to you. How do you read this sort of mixed picture of the labor market at the time of tremendous policy uncertainty?
Well, it looks like Doge didn't cause as much damage as people thought.
Not yet, right?
So, I mean, that's not nothing. Although I was always optimistic that, it wouldn't, especially because, wasn't maybe as many people as it seemed, or maybe these are people who are easily reemployed in the private sector. So, if it wasn't for the trade war, that's probably what we would be talking about. It's amazing. I mean, Trump is a master of sort of changing the conversation, that's for sure. But yeah, I mean, I think this isn't not important for a couple of reasons. One, we are experiencing an economic shock. It's policy induced and might be unnecessary, but it is a shock. And and shocks tend to be what disrupt economies, and how they respond to the shock tends to be about how resilient are you going in, and are you in a strong place going in? And this suggests, we are. And so whatever happens, with the tariffs, at least, we're going in a fairly resilient place.
Yeah. All right. I did throw up our decomposition of non-farm payrolls. This is the month-on-month net change, seasonally adjusted, so we can go through this real quickly. A couple of things I will point out. there was talk earlier in the year, Guy Berger, and maybe you'll add some more color to this, but there was talk that some of the weakness earlier in the year was a bit weather induced, a little bit of a colder winter than we had previously experienced. That might have had some impact on things like construction payrolls, leisure and hospitality, and so forth. And so there was some expectation going in here that this would be a bounce month. I don't know if a dead cat bounce or what you want to call it, but a bounce month nevertheless. So you do see here, going through our decomposition, we're at plus 28K overall. Let's see where your big moves are. So you're at plus 48K from trade, transportation, and utilities. Just wild guess off the bat, maybe that's actually some front running of tariffs. I don't know. You're at let's see. Anything else I want to call out here? We're at
leisure and hospitality, huge swing back.
There you go. Thank you very much, Guy. Yeah, plus 43,000. Of course, that had been a net reduction from that category in January and February. So is that then that weather effect, Guy, in your interpretation?
Yeah, the rise in the average work week too, I think, is consistent with this rebound. This may also be the kind of thing that leaves. I mean, I tend not to spend too much thinking about like monthly swings in average hourly earnings, but given that leisure and hospitality is very low paying sector, this could be the kind of thing that specifically depresses average hourly earnings growth this month. But yeah, that's a big swing. And unfortunately, what this sort of means is that this month is sort of presenting some strength that was robbed from the last two. And maybe they should be thought of together jointly. And maybe, by the way, there's more of a rebound I had in April as an echo of it too, that March was not able to catch up on.
Okay.
But yeah, I think it's all worth thinking about with the strong establishment survey and payrolls is it should be matched together with the less strong January and February data.
Guy, while we're in the decomposition, trying to make this conversation a little bit forward looking, as we look for the impact of tariffs in these numbers, several months down the line, you mentioned, you wish we were looking at the June report. What are the categories where we'd be looking for the biggest impact from tariffs, you think?
I actually think paradoxically, manufacturing may be one of the sectors take the biggest hits. I don't think it's a coincidence, at least early on. I don't think it's a coincidence that the first stories we're hearing about is about plants closing because of the tariffs. I mean, the numbers yesterday were small, but I think they're a hint to come. Manufacturing is very dependent on supply chains. Unless you're somebody who's literally digging things out of the ground or making primary inputs, and hopefully if you're in there in a capital light way, because capital goods are going to be taxed heavily, it's going to be disruptive there. And I would expect that to be the fact that in some cases, the hardest hit. I mean, some segments of manufacturing may do better, but it's not easy to build a t-shirt factory or
Poster factory.
Yeah, exactly. Right. Or to suddenly produce the car parts here. Some of these services sectors may suffer in the long run, might be resilient in the short run because their production's they're not being tariffs are not being levied. I mean, I guess a lot of tariffs are produced here anyway. A lot of them are capital light. And so I guess what I would say is I actually think manufacturing, construction is very dependent on expensive imported lumber, things like that. Those might be the first sectors to really show signs of weakness.
Yeah. Allison, a lot of people are out there, professional economists, talking about the R word, recession. Certainly we're going to get a hit to growth from this policy if any version of it sticks. What do you think that hit would look like? Again, we're starting from a place that you would hardly describe as terrible. 4.2% unemployment rate, growth all in actually looked pretty good in 2024. Is this the kind of shock that presents kind of sudden stop dynamics where, we wake up in Q2, which we're already in, and all of a sudden it's like, oops, we're in recession? Or is this going to be sort of like a slow developing sort of growth scare or even recession, in your opinion?
I mean, you never know. I would put my money on the latter. Well,
Okay.
not literally. I don't take active bets in the stock market, but you know what I mean. Yeah, because I mean, a lot of this is honestly driven by just the uncertainty. We don't know, one, how other countries are going to respond.
Mhm.
That's a huge unknown. Most people, as I said, we were saying before, haven't really thought much about tariffs really in their whole lives. They're just being told this is bad, this is going to cause a recession. But they don't really, it's not like we've had a tariff or a global trade war in the past that people have lived through. So I said, like, we also don't know. I said I was watching Bloomberg News all morning, and everyone on seems to think this is not actually going to happen. And even like sort of the bond market maybe even sort of hinting this. I think it's interesting that bond yields have been falling, and everyone's not surprised by that because it's like when there's uncertainty, there's a flight to safety. So I mean that seems normal. On the other hand, if we really have a trade war, or if we really like start retreating to autarky or whatever, I'd expect interest rates to go up. So people are effectively moving into an asset that's almost certain, if they believe the trade war is going to happen, is actually prices are going to go down. So that makes me think that people are really just like, we have no idea what's going to happen. This is pure uncertainty. And the way that plays out in the economy is just what we're seeing in the job market, which is no one's really being fired yet, but people aren't really going to be hired either. And sort of over time, that just causes more and more damage to the economy. There's just less dynamism. People feel like you just have less churn. And if you do lose your job, it's much harder to get another. So you kind of just have this sort of, uncertainty-based economy.
Yeah, I do think that question is so interesting, because it was certainly, like, when I think of it from like a CapEx standpoint, it's really, really hard for me to see how companies are going to invest even over the next 4 years here, right? Because you are now in a situation where you obviously don't know, you have no idea what's going to happen in the next month. If you take, sort of like the NAFTA renegotiations as the template, a lot can still change over like the next 18 months. And then, like, once you get past midterms, people are going to start speculating about, well, will the next president just lift all these things? Will the next president just go do a complete 180 on these policies? And that's possible too.
Or Congress.
What's that?
Or Congress.
Totally.
Like,
Right.
if
So
these cause a lot of damage, I don't see them sticking. I mean, that's the advantage and disadvantage of having them as an executive order. I mean, it's wild that one person can just do something like this that has such a big impact on the entire global economy. But on the other hand, like, they kind of can.
yeah. So Guy, as our labor market guru, like, how are companies then also thinking about hiring decisions in this context of uncertainty? How is that different from CapEx?
So I guess one thing that I want to mention here is I think there's a lot of emphasis on uncertainty, and I think it's very appropriate because there's still a lot of uncertainty. But certainty about bad news is not better than uncertainty about the fact that bad news might happen. And I think that's sort of what is hitting home, is that, like, in some respects things are becoming a little less uncertain. Just that they're moving in a bad direction. And we already know companies came in right after the election and became more optimistic about their hiring plans. And that has vanished. And the latest data we have on that even predates these tariffs. I can only imagine what's happening now. They're probably going to dial back on hiring plans further from what they've done. But I also think that, like, I guess I'd be very surprised if we don't see layoffs pick up. I mean, I know the Challenger data is surging. A lot of that's just what's going on in the federal government, but you've seen layoffs creep up a little bit. I'd be very surprised if this policy gets fully implemented with kind of GDP hits that a lot of GDP experts or forecasting experts are putting together, and we don't see layoffs pick up on top hiring declines. Like this does not this doesn't the magnitude here does not look to me like the kind of thing that just causes additional marginal cooling in the economy. Again, I don't like I think Allison was totally right that I think this is going to be gradual. We're letting a Lehman collapse and COVID color our image of how downturns usually happen, and these things, like even if they cause unemployment rate to go up a lot in a year,
Right.
it's still a year. And so I think like the way I would think about it is like this is going to be gradual. We're not just going to see like a million jobs lost a month or anything like that. But I think it's going to be, I think if it sticks, it's going to sap the economy's strength substantially.
Yeah. But to your point, Guy, that sort of counterintuitively, the sectors that may suffer the most may actually be like manufacturing related stuff. Like you also have to wonder how that is going to play politically, right? If you have a president who is out there saying, "I'm doing this, it's going to be painful, but I'm doing it to restore American manufacturing greatness," and then you have all these headlines about manufacturing companies laying people off. I'm being totally speculative here, but it seems like a reasonable scenario that we're putting together here. I mean, how does that not come back to the White House and cause a reassessment of things? I don't know.
Americans
if there's
like
an
buying
answer there.
stuff is all I'll say.
What's that?
Americans like buying stuff. For word sentence. I think that before, I mean, the manufacturing closures, if they happen, would obviously be bad, but I just think people are going to be mad they're paying a lot.
Yeah. Yeah, I'll take you to a quick Truth Social post from President Trump. To the many investors coming into the United States and investing massive amounts of money, my policies will never change. Talking about uncertainty. This is a great time to get rich, richer than ever before. I don't know if these kind of assertions, in as much as they come off as I don't know, out of touch, shall we say? I don't know if they're helping matters in this delicate moment for markets. Allison, you wrote about the developing world yesterday, and I want to talk about that a little bit as it pertains to the domestic economic outlook here. What do you think are the odds? Like we're talking about how a slowdown or even a recession might unfold. We're talking about sudden stop dynamics versus sort of like a gradual slowdown. What do you think are the odds that we actually end up importing this round of economic weakness from like some of these Asian economies that President Trump, for lack of a better word, kind of obliterated with the stroke of a pen on Wednesday?
Yeah, I mean, as much as they would like to restructure the global order and make us less dependent on the global economy, we are. And so I mean, as I wrote, this isn't good for the US economy by any stretch, but it probably won't be catastrophic, but it really will be for developing countries. I mean,
like
these
Vietnam, right? I
Yeah.
mean, what a hit.
Yeah, I mean, these are countries that, like more than like 60%, 100%, more than 100% of their GDP is tied up in trade. And now they're being slapped like 50% tariffs. I mean,
Right.
these are countries that really had an export development strategy. And as was encouraged by all of our fine global institutions, because this is usually is a means to growth. So, I mean, this really could roll back a lot of the great benefits of poverty reduction we've seen over the last 20 years. And it would be terrible for them, for humanity, much worse, I think, than cutting aid. But I mean, also, even just if we want to be purely selfish about this, isn't great for America either. Because it said this is a global economy. These were countries that were buying our debt, were supporting a strong dollar, all these things. So it's not. It said it's bad. It's horrible for them, and it's bad for us too.
Yeah, yeah. And I think what's going on in financial markets here is not insignificant for the real economy either. Call it what you will, the wealth effect. I'm a big fan of George Soros's theory of reflexivity. I think people's behavior is shaped by what they see going on in the stock market, whether or not they're invested in it personally or not. And I think that things that have happened in financial markets, including in emerging markets, history has shown have ultimately impacted the real economy back here at home. So I think not something to ignore. Just a quick update: your S&P 500 futures is sort of sliding back down a little bit here. Still down big on the day. Bond yields still down big on the day on the back of this number. It is really, really hard to back out any sort of unique financial market impact from this number on a day when markets are really primarily focused on Wednesday's policies, as well as the big retaliation from China and any possibly forthcoming retaliation that could be coming from other spots. So, Guy, coming back to you, as we try to understand how this is impacting the economy in the U.S., like what are going to be the best sort of high frequency data points to keep an eye on and understand when the impact is hitting us in the here and now?
I mean, the unemployment insurance data, claims data that comes out every week is the first place to look, because it's hard data and it comes out every week and it's fairly timely. I'd start with that. I really, really like, and this is an underrated data set that the census is publishing, at least for now. It's the business trends and outlook survey. It's a bi-weekly survey that the census conducts of U.S. firms, and asks them a ton of questions that are really interesting on various things, including AI adoption, which is a topic for another day. But it asks them things like, what are your employment plans? Are you how are sales going? Things like that, like a standard PMI type stuff, but very rich and split by industry, and sometimes by fairly granular industry, by firm size, etc. I tend to focus on the employment stuff because I'm really work at Guy. It comes out every 2 weeks, and so it's super timely. Those are the first two things I look at. Otherwise, the Indeed has that awesome job postings data they update regularly. Right. That's worth tracking. Those, I guess, are the things that I'm sort of starting out with a toolkit. Otherwise, I'm staring at the same monthly jobs data that everybody else is staring at. But I think that's really it. And the last thing I'll say is I think that the best, the stock market's not the economy, but the stock market doing very poorly or doing better are pretty good indications of the economic impact of these policies. When it's red, it's bad, and when it's green, it's good. And I think that's that you can do a lot worse than just literally defaulting to that right now.
Yeah. What about you, Allison? And also on the inflation and inflation expectations piece, you underscored your sort of surprise about the fact that bond yields are down as much as they are. This sort of knee-jerk reaction of the market, faced with a policy that is quite possibly stagflationary. So what to look at to understand if inflation expectations and things like that are trending in the wrong direction?
Well, yeah, I mean, I would look at expectations. I'd look at break evens, surveys, because, I think one of the big questions is, when are consumers going to sort of pull back and, due to the uncertainty that they're facing. There's a possibility that we're just going to see a bunch of spending this weekend because people are going to try to get in their spending while they can. I hear anecdotally a lot of people are buying cars before these car tariffs take effect. So again, there might be a bit of a lag on that. In fact, I guess they said a high spending report could actually in that way be a negative indicator. So again, I think consumer surveys all the soft data, the so-called soft data that's been pointing to economic weakness for a while is really sort of all we can look at, because, when we have, to me, financial market data, all the hard data is just flashing uncertainty. We don't know what's going to happen. No one knows where sort of this trade war is going to land. I still hear people saying this might end up with better terms of trade. Maybe this is, as you pointed out, the same drama we had renegotiating NAFTA, just on a global scale.
Yeah. Yeah. All right. Well. Listen. I'm going to wrap it up right there. Financial markets, stock market futures, bond yields, flashing extreme concern with this tariff policy right now. We end up getting a relatively positive surprise in non-farm payrolls, plus 228K on the back of sort of the reversal of some seasonal weather effects earlier in the year. Your unemployment rate does end up ticking up a little bit to 4.2%, but the big question is going to be where we go from here. So we'll be back in subsequent months to take it all in. Thank you very much for being with us.